You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. Stocks were mixed on the week. A correction in commodities pressured the market. Among other things, corporate deal-making and economic news was a focus. Microsoft's announcement that it is going to buy internet phone company Skype for $8.5 billion increased investor hopes that more such deals are yet to come. In the economic data column, the Commerce Department reported this week that March U.S. wholesale inventories rose. They also said the U.S. trade deficit widened a little more than expected in March. Retail sales reportedly rose for the 10th straight month in April, although a little less than the street was looking for. Jobless claims slipped lower in the latest reporting week, and we got word that wholesale prices rose 0.8% in April, and we'll be talking more about that a little bit later on at our roundtable. Shiraz Mian here with us right now, though. Is this week's commodity correction, because it did put a drag on the market, is this a bullish, rather a bearish sign of things to come?
It could be. There are two camps in interpreting the correction or pullback in the commodity prices. One group says that there was too much froth. The commodity group had become too bubbly and it's the air coming out of it. The other group says that it's the commodity price read on the U.S. and global economy, which is making investors a pause. And is basically a reflection that the first quarter slowdown may not have been so much of a transitory event, but actually could be carrying into the second quarter numbers as well. So it's this tug of war between these two competing views. Earlier last week, we had the bearish group more on the top, and it appears to be that the bearish camp is again coming on the top. The clincher last week was the non-farm payroll numbers, which conclusively showed that the labor market was on the mend. Until we get a conclusive evidence that yes, Q2 numbers are way better than what the Q1 numbers were, this issue will play out in the market. So yes, it could be a sign, an early sign that the economy is slowing down.
Okay. We had volatility back in the market again this week, but you wrote, and I read it plain as day, don't fret the near-term wavering. What does that mean?
It tells you where I fall in that tug of war that I alluded to earlier. I believe the economic momentum is on pace to grow from the first quarter's 1.8% growth rate, something about 2.5%, maybe even about 3%. And that outlook will eventually play out, but it's not going to play out next week or maybe even next month. My sense is that we will have this tug of war and this tension between these two camps over the entire summer months. And that's the wavering that I'm asking investors to not fret about and to look at the bigger picture, longer term. There are fundamental drivers in the economy on the labor market side, the consumer side, as well as the manufacturing side, which gives enough of fuel for sustainable 2.5% to 3.5% GDP growth rate.
Okay. Kevin Matris, last week you were here with us. You told us that we could make money in the market using options and as one strategy. Still can, but you're back again this week to give us yet another approach to hammering our way through this market and making money.
You know, there's really going to be a lot of ways to make money in the market, whether it be options, stocks, whatever. But I think the best way is really the way that is right for you. And what I mean is that you want to invest in stocks and in a strategy that is in alignment with who you are as a trader or who you want to be as a trader, because if you find yourself getting into stocks or trading a strategy that is not in alignment with who you want to be as a trader, you're going to abandon that strategy the moment the market hits a rough patch. And we've seen a rough patch really in the last couple of weeks. So if you're in the kinds of stocks that are not in agreement with who you are, you're going to find yourself getting spooked out of the market at the smallest instant.
All right, give me an example.
Well, take a look at it. If you were to look at momentum stocks, for example, momentum stocks had been on a tear in the previous several months prior to the last couple of weeks. In the last couple of weeks, you did see the market pull back. But the thing is, if you were, let's say, a value style trader, right? While stocks are going up day after day, week after week, if you could not resist the temptation of getting into these momentum style stocks, you probably would have hopped on board. You probably would have had some good success for a period of time. But the moment the market went from 12.8 to 12.5, you probably would have abandoned those stocks immediately. And that's the thing. If you were in, let's say, if you're a momentum style guy and you see those stocks pull back, you're already used to that volatility. But if you're a value style guy, you're going to be completely spooked by this volatility, and then you're going to get out wondering why the market is so unfair.
Bottom line, do what's right for you.
Got to do what's right for you.
See you at the round table. We'll see you straight ahead. Stay with us. Here is your Bull and Bear stock of the week. A chemical company and another retailer. This week's Bull and Bear of the week. Shiraz Mian here with me once again to fill us in on the details. The chemical company is Eastman Chemical, and EMN is the ticker on the New York. Why is this a bull?
They are doing everything right. Is the quick take on why they are the bull. They implemented a number of restructuring initiatives before the downturn came in 2008, and when the time came for the upswing, they were more than ready to enjoy the benefits. In fact, in 2010, they were doing so good that folks on the street were talking that this is the peak, and this is about as good as Eastman will do. But they continue surprising to the upside. In fact, the first quarter, they had pre-announced, pretty good pre-announcement before the earnings release, and then when the actual report came, it was even better than the pre-announcement. So overall, what they have done over the last few years is that they have removed the cyclicality, or reduced, is probably a better way of putting it, the cyclicality of their business, and significantly improved the earnings power of the core business. So margins are expanding, they have more pricing power, primarily as a result of the economic upturn globally. And that's basically getting down to the bottom line. And we are seeing estimates going up. They're producing a ton of cash, and they're not hesitant to return part of that to shareholders. So they pay a good dividend, yielding about 1.8% right now. They're buying back their shares as well, and investing a decent amount in their business as well.
And they're diversified too. I mean, they're in industrial gasification technology. They're in plastics.
That's right. Those were one of the things that they did, that they removed and went away from the core basic chemicals businesses and into more specialty and more stable end markets, and that's what's paying off right now.
Okay, Office Depot is the retailer, and you've been really taking off against retailers lately.
It's been kind of a soft category. The retail environment, the consumer environment has been kind of soft, but Office Depot has some company-specific issues of its own. Now, broadly, the office product category has been relatively weaker and hasn't really taken off, as, for example, some of the other retail segments have. And the environment for this group is improving, but Office Depot is faced with some challenges of its own. They have problems at the top. They're looking for a CEO. And more importantly, their core bread and butter business, was in the small to medium-sized private businesses, and in that category, they are experiencing a lot more competition than they were used to. Staples, the industry leader, made an acquisition at the time of the downturn, which was geared primarily towards their core end market of small to medium-sized business. They have a reputation of being a much better executor of servicing that business, and as a result, Office Depot has been losing market share. They also have recurring, non-recurring items in their results, and that's weighing on results as well.
Okay, an interesting screen up next. Screen of the Week, an overview of a timely strategy aimed at helping you become a more effective stock screener. First profits, that's what we're screening for this time with Kevin Matris, our top stock screener here. So we're talking about companies that have finally posted a profit.
Right.
Their first profit.
Hallelujah.
As a matter of fact. Why this particular topic this week?
Well, with first quarter earnings season winding down, I think it's a pretty apropos screen, something that I like to run all the time, right around earnings season. But again, it's always important to be able to find companies that have just recently shown their very first profit. It's an important thing. It's a Herculean achievement, and that's why we're looking at it.
And why is it important?
Well, first let me say that a lot of these companies that we will be looking at may be relatively new. And the first profit that we're talking about could be the first profit in the company's history. But oftentimes, you'll see companies that have been in existence for a while. They've been profitable, good companies, whatever. But for whatever reason, maybe they had fallen on some difficult times and they weren't able to produce a profit, but they have now finally been able to get back into a profitable position. And the reason why I like it is because the concept is, once you are looking at a company showing, a trend of improvement, usually that trend of improvement will continue. Whether that means they are, finally getting profitable, or whether that means that they have just continued to be profitable. But it's that trend that we are looking at. The other thing too is, for myself, and I know there's a lot of other people out there as well, there's a lot of people who don't like even looking at a stock if they can't show a profit. Mm-hmm. So the very fact that a company can finally get into the plus column is going to put that on people's radar screens, which indeed should increase demand for that stock.
Yeah, I know what you mean. Even if a company is getting better in many ways, if it's not able to make that profit, kind of hard to justify in your mind buying the stock.
First off, by the very definition of growth, if you got a company that is just progressively getting less unprofitable, that is still growth, right? They're losing less and less money. But again, it is entirely different being able to actually see a company put in the first print and actually make some money, and that is what we're going to be kind of concentrating on.
All right, set this baby up.
All right, so first off, the stuff we are looking for is, we're looking for EPS for the previous 4 quarters less than or equals to 0. This means that each of the previous 4 quarters, except the most recent quarter, they have not been able to show a profit. Next one is the EPS for the most recently reported quarter is greater than 0. This time their company reported earnings where they actually did show a profit. And for good measure, I usually like to look at companies that are trading over $5. I also usually like to look at companies that have 100,000 shares or better, but that is the crux of the screen.
And some stocks that came through.
Bunch of stocks that came through. Here's 5. Cost Plus, Global Geophysical, Ligand Pharmaceuticals, Rex Energy, Western Alliance. All of these companies look great, finally have been able to get profitable, definitely ones to keep on your radar screen.
And you say you do this every earnings season?
Yes.
And have you ever found that you can't come up with a company that's made a first profit?
I bet there was probably a time in 2007 and 2008 where that happened, but usually there's always something which is showing that first profit.
And the number of stocks generally varies from?
Yeah, they can vary quite widely.
Okay. See you back at the Roundtable, and we'll see you at the Roundtable as well. Stay with us. More still ahead on Profit from the Pros. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Wholesale inflation and jobs. That is what we are going to talk about this week with our pros, Research Director Shiraz Mian, Equity Strategist Bill Wilton, and Market Technician Kevin Matris. All back with us for another edition of the Roundtable this week. Shiraz, I'm going to start with you because we talked a little bit about this in the beginning of the program. The inflation numbers, we didn't talk about it, but I mentioned the inflation numbers at the wholesale level. Up 0.8% was the top line number, core inflation up 0.3%, and that was a little bit more than the street had expected. Is there inflation pressure in the economy?
There is, yeah. We have been seeing this over the last few months, in fact, that the rise that you've been seeing in fuel and food costs have been showing up at the top line number. Now the monetary authorities look at the core, which strips that out. And the Fed has been quite comfortable saying that these pressures are transitory, and it appears that the sell-off in the commodity prices over the last couple of weeks is bearing that out. So the Fed may actually be right in the inflationary pressures being transitory and temporary and reversing themselves. So there are pressures definitely from the levels where we were at this time last year, but they don't concern me. I don't think they represent a danger to the broader economic growth or to the broader outlook that the Fed has for monetary policy and interest rates. So yes, they are rising, but it appears that they are reversing as well.
Okay, so Bill, if those commodities continue to sell off, as Shiraz was describing, he already doesn't see this inflation as a problem. Will it be even less of a problem after that sell-off continues?
Well, that's one of the reasons that they strip out a lot of those commodity-related inflation pressures when they do talk about that number, because as we've seen over the last couple of weeks, they can be extremely volatile. The only concern there is how long it's going to take for that sell-off to hit the consumer. So as we've seen, especially with energy prices, they're very downwardly sticky, meaning they can rise very fast, but it's going to take a little bit more time, for the price at the pump to trickle down along the lines of crude. So it's going to take a little bit longer for it to reach the consumer, but like Shiraz said, it shouldn't be a problem in the long run. It's just a near-term hurdle that we have to overcome.
Okay.
Right.
Kevin, let's bring you into this conversation. Jobless claims down 44,000 in the latest reporting week.
Good news.
Though still the level, 434,000 overall, still too high to signal a strong labor market recovery. Does that concern you?
It would be great to get back under that 400K level. We were there several weeks ago, and it was really refreshing to see that. A couple weeks ago and this week again when we popped back above there, that did cause some concern. But, we had been on a nice downward trend with new claims, so it's not unreasonable to see a bit of an upward correction. I think it's several steps down, maybe one or two steps up. I think that this trend of improving claims is going to continue very, very soon. That is going to help the economy, and that's going to help the stock market.
So you don't think that all the up and down we've seen recently with jobless claims is going to weigh on the economy?
I still think that there is an overall trend of improvement. So if you believe that this is the beginning of something getting worse, then it's going to weigh on the economy. If you believe this is just a continuation of improvement, then you can make the case. You have to make the case that the economy is improving and the market will get better.
Okay, sure.
Just a small comment on the jobless claims numbers. When the series started reversing at the beginning of April, a number of folks came out and cited these administrative reasons and technical reasons which were causing the series to go back above the 400,000 level. And the drop that we saw this week, the over 40,000 drop, really reflects that those explanations were on the mark. So the overall trend, as Kevin mentioned, is downward, and that's a positive sign on the labor market front.
Okay, you're just all positive today. But one thing that I'm noticing, just real quick here, we've had a shift lately in the economic landscape here in this country. And economic growth used to lead to jobs growth. That we see no longer happening. Are we going to have to redefine that whole issue going forward?
jobs growth always lags the broader economy's growth. So it's been slower in this recovery than we have seen in the prior recoveries. But as we saw in the last 3 months, we are seeing 200,000, 250,000 level job growth. The productivity numbers are coming down, which is another push for the corporate sector to start making hiring. So you're right, there is some slowdown in that relationship, but the relationship still holds.
Okay, Bill, just real quick, you're just overall optimistic here too on the economy?
Yeah, absolutely.
I just want to make this a unanimous
Well,
thing.
one of the things that I took away from actually the non-farm number, I like to zoom out a little bit. I find the initial claims to be a bit too myopic. But watching the unemployment rate actually rise was a good thing because people are more encouraged in the job market, so they can go back and start looking for work.
All right, Kevin, give us your top stock pick of the week.
Mine is J-Bill Circuit, ticker JBL. They are in the electronic manufacturing and services industry, and they have a worldwide presence. They service the commercial industry as well as retail industry, electronic stuff. What I like about them is they have double-digit projected growth rates, tiny, tiny valuations with a price-to-sales ratio of literally only 0.3. I believe that there is a $27 price target. I think they're going to break out pretty soon. That's a 25% increase from here.
Okay, I'm going to work my way back up the street here, Bill.
I'm going to talk about Trinity Industries. This is more of a play on the broader economy. Anything that you eat, wear, use is on a truck at some point or a rail car, and they lease those intermodal transportation units. So as long as we're getting better, they should be doing well.
Okay, Shiraz.
Autodesk. This is a software maker. The software they create is a leading product that's used by the engineering and architecture and industrial design firms. So AutoCAD, 2D and 3D versions of the product provide them with secular as well as cyclical leverage to the economy. The outlook for the company is extremely good, and I see a significant upside.
Okay, I'm going to put in another quick plug for Kevin's book, Finding Number One Stocks, available at Amazon and other leading bookstores. Thank you for joining us. Hope the week ahead is a profitable one for you, and we'll see you next time.